Anne's session just there, as well as being an incredible view into some of the things that are possible when you start bringing together a holistic set of data that really starts to illuminate and bring to life people's full financial lives. I think as well as that, it's a really fantastic segue or introduction into this final panel session of the afternoon, which really is going to try and look at where we are in the automatic enrollment rollout in terms of the overall financial lives of the people who are saving through automatic enrollment. And in a moment, I'll ask our fantastic final panel of speakers up to the stage. But first, I'm just going to say a few words. And I'm going to kick off this final panel by quoting a famous French philosopher, which, bear with me, I know that's not a normal way of starting a presentation on pensions, but maybe it is in France, I don't know. But I just really like this statement from the philosopher Albert Camus, who once wrote, "Real generosity towards the future lies in giving all to the present." Now, clearly Albert Camus was not an actuary. I think we can all assume that. But I do think there's a really strong point inside that statement. And for the final session of this conference, one of the things we're going to try and do is ask whether sometimes when we look so hard at people's futures and how to target the right kind of outcomes in retirement, we're sometimes failing to be generous enough towards their present. Now, we've heard a lot today about one of the world's biggest behavioral experiments, automatic enrollment, which is clearly now become something around the world people are looking at to try to see the impact and effectiveness of those sorts of behavioral solutions. And I guess we've had a lot of detail, but the one headline we can kind of fairly safely give is it's going pretty well. And as we all know, automatic enrollment is great because it's a technique for making us better at things which are traditionally hard for us to do ourselves. It means that things like default policies mean that we don't have to fight our own battles against the demons of our worst nature. Things can be done for us. So those sorts of interventions are great, but I guess one of the things I just want to flag and talk about in the context of automatic enrollment is very often default solutions are really targeted at just one outcome within one relatively narrow sphere. So they might be very good at getting large populations to do the same thing at the same time as we've achieved in automatic enrollment. But they're not always very well tailored to the diverse circumstances or lifestyles of the huge populations of people who are being defaulted in. And just to give you an example of why this might matter, I just want to say a little bit about our own experience in setting up Nest Insight and where we've got to in terms of the kind of research we're doing. So we set up Nest Insight to help understand how to help people in DC schemes get better outcomes in retirement. But one thing we very quickly learned is that when we look at the sort of population who are in Nest, especially we heard this morning from Steve, the 75% of our population who earn less than £25,000 a year, which looks very different to, if you like, the traditional corporate pensions advised population. When you think about that population, it's very hard to try to create good outcomes for them a long way off in the future without taking account as well of their short-term financial circumstances. And just to use one example of where that's led us, Will mentioned this morning our work around the sidecar savings solution. This is a trial where we'll be using behavioral levers to try to encourage people to save in a short-term liquid vehicle as well as a long-term illiquid pension vehicle. And of course, the origins of this sort of approach lie with fantastic work by behavioral scientists like David Laibson, Bridget Madrian, who's a lead partner on the project, exploring optimal ways to help people distribute their money between short-term, medium-term, and long-term goals, and asking the question whether there's an optimal way of doing that for people. And although sidecar, this thing about having two accounts instead of one, that's a relatively simple mechanism, we certainly hope that our trial will show that even such a simple intervention can actually really help Nest members balance between these short, medium, long-term goals. However, at first glance, it might seem strange that a pension scheme is kicking off such a major trial of an approach that prioritizes, if you like, short-term as well as long-term savings. Why would we do that when surely all we want to do is get people to build up the maximum possible defined contribution pot? That's what we're there for. And I think even taking that relatively narrow view, I think there are a number of reasons. I can quote 3 reasons, really, why a pension scheme and its trustees would want to think about those short-term savings accounts. One is, we know we've got some colleagues here from the Money Advice Service who will happily tell you that almost half of us in the UK don't have £500 on hand to deal with a financial emergency. And yet 75% of us will experience a financial emergency over the course of every year, and those financial emergencies on average cost more than £500. So that you don't need to do the maths to work out that's not an ideal situation. And so the consequences of this for people, particularly on lower incomes, can obviously be really extreme things like debt spirals, and those are things that can ricochet right through people's lives into retirement. So immediately thinking about the short term is actually partly thinking about retirement. Secondly, people who experience these kind of shocks very often quite naturally will look to tighten their belts to deal with the impact of these shocks. And one thing that almost certainly means is they're probably not going to want to contribute to a pension as long as they've sort of noticed that a contribution is going out. So that has an impact on their pension savings. And then thinking more broadly, those sorts of shocks can have a really profound effect not just on people's wallets, but on their well-being. And those well-being effects can impact their ability to go to work, to earn, and their personal capital. And of course, if they're earning less over their career, they're not contributing as much to a pension. So even if we wanted to take a really narrow view about pension savings, because of the nature of the population that we're there to serve and their level of earnings, we can't really achieve the goals that we're looking to achieve without thinking about the short term as well as the long term. When it comes to low to middle income savers, it's impossible to think about these things in isolation. And I guess what we're going to try and look at in this panel now is whether we need to be taking a more joined up view. And as we come to the end of the phasing process, I think quite rightly, of course, we've heard it said a number of times, a lot of us are thinking about whether we should be encouraging people to save more into their retirement pots. But I guess the question we want to ask now is, would we be doing them a disservice if we pushed for that aim without first thinking about their entire household balance sheet and understanding all the impacts of different kinds of savings on them? Is there a risk, I guess we could say, is there a risk that in creating a nation of savers through automatic enrolment, we might nonetheless have a group of people who would still fall into dire trouble if the washing machine broke down? Because that wouldn't be the objective. And so that's why this final panel, we're going to ask whether we can help people be generous to their futures, maybe by first giving more to their present. And we want to ask how to help people with their financial well-being today as well as in the future. And along the way, particularly, we want to consider some of the very specific challenges you face if you're on a lower income when you're trying to deal with your savings needs. And to answer that question, we've got a really fantastic panel who I'd like to now invite to the stage, please. Thank you very much. I'm going to introduce them as they come up, so there's not that embarrassing pause. We're going to hear from them in this order. First of all, Carl Packman, who's the Research and Good Practice Manager at the charity Toynbee Hall. He's going to be looking at the savings behaviours, the actual savings behaviours on people on lower incomes. Carl's written extensively about financial inclusion and household over-indebtedness, and particularly he worked on a really fantastic Toynbee Hall report from last year, looking specifically at formal and informal savings in these groups, and he's going to be sharing some of the insights, particularly from that report today. Then Professor Anandi, who's at the Blakstad School of Government in the University of Oxford. Anandi's going to consider some of the links between poverty and cognition and ask whether poverty actually causes people to make worse choices. Anandi's one of our leading behavioural scientists in the field of poverty and social inclusion, and we're really thrilled to have her here to share some of these findings. And then finally, David Mitchell from the Aspen Institute's Financial Security Program is going to give us a US perspective on this question, looking at some of the really innovative work that's being done across the Atlantic to help address the financial needs of lower income groups. And I just want to say in this context, Will mentioned it earlier, but Nest was really excited to announce earlier this year that we formed a research partnership with Aspen, which is already helping us share ideas and practice between our two very similar and also very different countries. So it's great that David's able to join us here and share his perspective. But first of all, I'm going to ask Carl to present. Thank you.
Thank you very much. Thank you for inviting me and that lovely introduction. And it's lovely to be slumming it in this OK building. Toynbee Hall looks a bit like this. By way of introduction, Toynbee Hall is an anti-poverty charity in the East End of London. A lot of the work I do looks at issues around financial capability, looks at financial exclusion, but more widely, we're a legal advice centre. We have things like financial education services at the centre. And I want to introduce the work that I did last year. It was supported by JP Morgan Foundation in this country. that looked at the informal savings behavior of low-income households. The motivations for us to do a piece of work on that was that we had plenty of data, official data, and other research data that looked at the formal aspect of savings. Government collects very good data on that as well. And what that tended to show with the sorts of people that we're interested in and we see come through our doors at Toynbee Hall was that there was either low engagement or low numbers in terms of savings value for savings behavior. But we knew that there was something more complicated perhaps going on in their lives, and that their savings behavior was so-called off-grid, not necessarily being captured by the official data that we see from government and other agencies. So we wanted to explore through a literature review what kind of informal savings and motivations and methods low-income households tended to take with regards to informal. But our project was a qualitative project focusing on 24 people who were for a mixture of, they were either single parents, advice users, so we drew from people who were come into our advice centre, and also millennials. So we had a focus on those three groups of people. There are 24 of them, and we engaged with them over a 3-month period regularly. And what we wanted to do was establish whether informal savings was having a positive effect on people's financial resilience and also their financial capability. So it wasn't just that they had this pot of informal savings, often literally in jam jars, but whether that was having some kind of positive behavior on their savings behavior in the future as well. So as I say, the methods that were employed by people to informally save included some of the more obvious ones, jam jarring literally. Often being the case that, we heard this a few times, people would jam jar and take to the local supermarket where there would be somewhere to tip in all of your spare change. You pay 0.7 on the pound and you get all of that in a cash back or in notes. And often careful spending as well. So it was very interesting to hear the sorts of stories about how people would spend all of their days on Saturday just going around various different supermarkets to get the best deal, go into markets where they can still pay pounds, in cash, but get plenty of sort of fruit and veg that you wouldn't necessarily get for the same value in supermarkets. We told some of these stories in our report. We wanted to demonstrate that often poverty, often being in vulnerable situations and circumstances, isn't the fault isn't that person's imprudence or even their stupidness. It is very much the environment in which they sit in. They're often the most calculating about their budget in a way that the gentleman over here sort of spoke about in the question answer session before. One of the things that we spoke about during the interview sessions was overpayments. So in the previous literature looking at informal spending behavior, but also informal savings behavior, overpayments was something that came up. So if you overpaid on your utilities, for example, during periods where you had more money, you could essentially have the same level of heating and gas and electricity and other things, other essentials, in periods where you knew you weren't going to have so much money. That wasn't necessarily something that we heard with the people we spoke to. And the reasons for that was because even after spending on essentials, people didn't have a lot of money left over. So that meant that the savings behavior was only kind of through careful spending. That was their only way of being able to save at all. One of the things that the interviewees on the whole were telling us was that keeping it liquid, that's sort of the terminology that I might use, but keeping it accessible, keeping their savings accessible was something that was very, very important to them. And what a lot of the people that we spoke to were less enthusiastic about was putting some of that cash and some of that savings into something that was relatively locked away, or indeed locked away for long term. That was something that created an element of fear for them. So it was important to have access to that savings all the time. And I think that message for providers of savings products and pensions products is quite important when we're directing that or marketing that towards low-income households, that having that access to that savings regularly, quickly, is very, very important. Not having that access is probably going to be a barrier. And on that message as well, being able to control what they save. So money that's not sort of disappearing out of a current account without them knowing is also something that is very important for those guys. In terms of what motivates people to carry out that informal savings, having a short-term buffer is very important. It's no surprise, or it won't be any surprise, that those people that we spoke to who were from our debt advice services said that having a short-term buffer was the only motivation for being able to save, so they didn't get themselves into a situation later on down the line where they were overburdened by their own debts or having to go to debt advice services because, and being very honest and frank about this, a lot of the people we spoke to who would go into debt advice weren't happy that they were having to go to debt advice. So having savings and discussing with their advisor what the best method for them to be able to save informally or formally was an important thing for them to ensure that they didn't have to go back to the debt advice setting as well. Sometimes that's a very difficult thing to say as a representative of a debt advice organisation, that sometimes people don't want to come and see you, but that's probably quite understandable as well. Some of the other motivations were towards a personal reward or having a treat. So children come into play when it's come to savings behaviour and savings motivations. Beginning the journey of life goal savings. So some people saw short-term or informal savings as a kind of gateway to being able to be more comfortable with longer-term savings and even pension savings as well. The most interesting aspect of that for me, also at the same time I was doing a research, in the research and in the report, I was illustrating a lot of the behavioural insights from the literature review that had been picked up around the world that was useful for us on this informal savings piece, was having money just to save. That in itself was a reward and a motivation for people. It doesn't necessarily get captured in a lot of the literature that we see today. So I think that's important for product development as well, product design, that it's felt that if you have a goal or if you set a very, it could be ambitious, but demonstrably good goal, like the holiday, like the car, like a pension, it's felt that a lot of people will come with you on that journey as well. Yes, I want a car. Yes, I want a holiday. Therefore, savings towards that is going to be a goal. But there's an awful lot of people out there for whom those goals they couldn't be further from what their life dreams are. They don't see that as being a goal that is in their reach now or in the future. So that has the effect of demotivating people to save. But I was very surprised to find that the motivation for people to save a lot of the time was just being able to demonstrate that they could save and that they had something to save. Often that was bound with aspects of their upbringing. They wanted to match the sort of savings behaviour that their parents wanted to do, or did. And it was very important to them to be able to demonstrate to themselves that they were in a position to save. It's very complicated to turn that into a product, but nevertheless, very important aspect of someone's savings motivations for those people that we spoke to. So I'll go very briefly into some of the barriers and then motivations again into why people were saving, and these reasons are quite common to all the groups we spoke to. Low funds was something that was a barrier to saving. That probably comes as no surprise. A preference to spend and the attitude of living for the here and now was something that we heard was a barrier to people's savings, and sometimes that isn't an irrational desire to live now. If you're on a very, very low income, sometimes this notion of living for the moment sounds kind of crude, but for people who don't know what's coming in the next month or even next week, living for now seems to be a way of managing that experience. But it's very difficult to describe often for people who haven't had that experiences themselves. One interesting one also was empty nesters. It's assumed that those people whose children are moving out go back to a previously set savings behaviour, but for some of the people we spoke to, having now an empty nest sort of in a kind of strange way demonstrated to them that they didn't need to be as careful as they once were when their children are at home. So an empty nest situation was sometimes a barrier to save in a sort of strange, complex, but that was the reasons that they were given to us. Being in the red was also a barrier, so having to sort of spend on debt or servicing debts, for example, was a barrier, and also this notion that saving is for other people. That was often the feeling that savings were for middle-class people or upper-class people. That was something that we heard a lot of people say were their barriers. Now, the reasons for the motivations for people were children, that's no surprise, children leaving home, so the inverse of the other empty nesters. A dried up mum and dad bank, which was very interesting for those people who are millennials who are now independent, not having that fallback to go back to the bank of mum and dad, if that was there for them, is all dried up. But also now I'm slightly older, it's a bit more embarrassing for me to have to go to mum and dad. Those things were motivations in a way for savings. And also relationship pressure. So a couple, two people, if the other person in the couple is saving and saving a lot more than you, that was often a kind of motivation to save as well via, I hope to keep up with them, then they're going to tell me off when we're shopping and my card fails, that sort of thing. All of those things were motivators. So finally concluding, what the recommendations and what my sort of conclusions were in this report was that there was obviously lots and lots of motivations for people to save informally that hadn't previously been looked at, explored in quite so much depth. But there is also a tendency for product developers, product designers who are picking up this research or other research like it to say that savings should come at all costs. Savings behavior is an inherent good. Therefore, we want to extol the virtues of being able to save. We wanted to not necessarily say that. We do think savings is a good, but we also feel like there are times when savings isn't necessarily the right thing for someone to do. So if someone is paying down a high-cost credit debt, for example, that is generally very, very expensive, we wouldn't necessarily say that savings at the same time as doing that is the best thing to do, not least in the consideration of a low-interest environment that we're in today, but also it's probably better to try and get rid of that expensive debt quicker than it is to try and build up a savings. There does pose a challenge for designers, though. Demonstrating or learning, having a savings habit is very important. It's also very important for people who are paying debt to be able to learn and formulate a savings behavior, a savings pattern that works for them. It's just very difficult to be able to generate that savings pattern for someone for whom it might be better to pay down that debt. So one thing that we're very interested in is seeing product services, incumbent mainstream banks and fintechs alike working with providers of credit to be able to translate the kind of debt repayment behavior that someone is paying down, if it's a specific amount monthly that they're putting into paying off their debt, and turn that into the type of money that they're putting into a savings pot later down the line. That behavior is taking place by cordoning off a bit of money in your account or cordoning off the cash to pay back that debt week on week, month on month. To be able to turn that behavior, which is something that they haven't necessarily chosen but having to do, and putting that into a savings vehicle is clearly one way of capturing that behavior type of sort of cordoning off money and putting it away. So something like that, some fintechs are already doing that with credit providers, and we're interested in seeing that scale up and become a norm rather than individual instances of where that's happening. In terms of what insight we captured from that report, preset goals, as I said, the sort of home, the holiday, sometimes they can be bad. So allowing people to determine what goals they choose, what goals are good for them, is something that is better than someone else saying you should have this, because that starts to look like you're telling a low-income household person, a person in a low-income household, what's good for me is the same as what's good for you, and that jars with some people for maybe obvious reasons. In terms of the challenges, one of them I've already mentioned is savings leads to control, but that person's priorities are ever changing, so they do want savings that they can access. There's also a lot of people who want to use that informal savings to start to be a gateway to longer term savings, but there's a very difficult challenge there on how to make that happen. So hopefully that's a prompt and sort of prod at what kind of discussion we have later on. I haven't answered all my own questions in that, but hopefully it can lead to a bit of a debate later on. Thank you.
Thank you, Carl. Well, David, that's certainly laid down the gauntlet to talk about what good solutions look like.
Thank you. Yeah, that's quite a challenge. We covered a lot of ground there. Thanks, Matthew, for having me. Thanks, Will and Michelle and the whole Nest Insights team. The Aspen Institute, for those who don't know, is a US-based think tank that focuses on issues domestic and international. Sadly, I work out of the DC office. There is an Aspen office. But the financial security program at Aspen focuses on strengthening both consumers in America, consumers' short-term stability, financial stability, while also trying to expand wealth-building opportunities. So trying to sit in this niche between the scarcity issues and the short-term challenges that folks are facing and the long-term, asset-building opportunities. I've been asked to give the American perspective on some of the multi-pronged elements of the problem, as well as some thinking that we've done on solutions. I don't think anybody in this room would ask this question, but there is this question of why should Brits care about what's happening across the pond? And I mean, I think Anne made this point and others have talked about it, but I would refer to the framing paper that we did with Nest Insights earlier this year, announcing the partnership that we have with Nest on all the various parallels between our two retirement systems and development over the years that's really mirrored itself in a lot of ways. So I do think there's a lot to learn on both sides. So historically, Aspen FSP has focused on the long term, actually, so retirement. And I could have picked any number of stats to demonstrate that I think we're a little bit behind the UK, especially on the private savings front, regarding access to workplace plans, regarding amount of long-term saving that's happening. And there's obviously the leakage issue that has already come up. But it's only kind of more recently, in part informed by analysis that the Consumer Financial Protection Bureau did in the US, that we came to realize, and it's a fairly obvious point, but that for folks who are struggling to meet their day-to-day and month-to-month obligations are not going to be in a position to really think about the future or to plan for the future or to save for the future. So this just kind of represents what CFPB found when they did this exhaustive definition exercise around what is financial health, what is financial wellness. And you can see there's both short and long-term elements to it. And there's, the retirement element would probably fit into that bottom right box. But even there, it would be one of many challenges and concerns that consumers are dealing with. So I want to just quickly sketch out some of the key stats on the short-term side from the American context. And this will mirror a little bit of what we've heard already about financial shocks, amount of emergency funds on hand. It's pretty distressing stat. So 60% of families experience a financial shock during the year, which could be an illness in the family. It could be a house repair, a car repair, a death in the family. There's a number. This is from the Pew Charitable Trust, that stat. And then the Federal Reserve also surveys to ask a similar question to one that was cited, I think, earlier about, if you had a $400 expense, could you cover it with cash on hand, or would you need to borrow or talk to family and friends? And 41% in the most recent survey said that they could not come up with $400. So even if you escape a major shock, there's chronic ups and downs that we've found. So this is from the JP Morgan Chase Institute, actually, so similar data to what Ann was referring to earlier, looking at this administrative data, this huge data set of their customers and understanding all of what all the cash flows coming in and going out. And they found that 93% of Americans regularly experience at least a 5% change in income month to month, and that 55% experience more than a 30% change. That's basically a housing payment. That's a lot of a household's budget to have to plan around every month, not necessarily knowing what's coming in. And then Americans are also struggling with consumer debt. Again, lots of potential stats to show this, and the US is probably a little bit unique, especially around student loans. But this graph just illustrates the startling number of Americans who have zero or negative net worth, excluding housing. So it's a big number, over 30%. There's also a few interactions between the wealth and financial security stats that we're most interested at FSP and other data points. So the racial wealth gap is one. It's the numbers kind of speak for themselves, but communities of color in the US are much more likely to have zero or negative net worth, and the wealth gap has actually been getting bigger over the decades, despite what you might think. And then the other, in addition to race, the other interaction in the data that we're particularly interested, that I think will relate back to some of what we've heard today about the sidecar accounts, is the interaction between short-term instability and retirement savings. So this is actually new analysis of the question that I referenced previously about the $400 in a pinch. Could you come up with it? And the first thing we asked was, okay, how many of those folks also are actually contributing or own a defined contribution retirement account? So I think the expectation was that these are a bit two different populations, especially in the US context where it's a voluntary retirement system and a lot of low wage and small business employees are not covered at all. You would think, well, that's the folks who can't make the $400 payment. But it turns out that there's something like 35 million Americans who are in both categories. They are saving for the long term, and yet they can't come up with the $400. And then this graph kind of takes it a step further by making the point that those who can't come up with the $400, not surprisingly, are more likely to then withdraw, cash out, or take loans out of their defined contribution accounts, which we've already established is a bit of a unique feature in the American system that you can even do that. But it does speak to kind of the dual purpose, as Steve mentioned, that these accounts are currently being used for. And I think raises the issue of potentially a sidecar or somehow otherwise using mental accounting or making it easier on folks to see that the money that they're putting into the defined contribution account really should be locked up and that they should be saving for short-term emergencies elsewhere. Kind of following up on this interaction between financial insecurity and retirement, one other area that has gotten a lot of attention in the States recently is consumer debt holdings in retirement, and then on the flip side, to what extent is automatic enrollment potentially leading to additional consumer debt being taken on in working years. So there is a lot of recent evidence that kind of working life financial security is following savers into retirement. So the graph on the left is just the percentage of households over 55 who are holding some kind of debt. And you can see just a general upward trend, particularly for the 75 and up cohort, which really flies in the face of kind of the life cycle model that you would think, by that point, you've kind of paid down any big debt expenses that you've taken on and you're just spending down savings. But clearly that's no longer the case. And the graph on the right is kind of a similar point, but about the amount of debt that's being held, not just that folks are holding it into retirement, but that the debt to income ratios are also going up. So jumping ahead now to possible solutions, which I think I'll go pretty quick here so we can have a discussion about it. The question arises what we should do about these multi-pronged problems that both Americans and Brits are facing. At Aspen, we're not willing to abandon the idea that retirement security should be a big part of the mission here. It remains one of the two major ways that at least Americans build any wealth at all, really that and through their homes is how that happens. But at the same time, we can't ignore the day-to-day challenges. So we created a solutions framework that might be helpful in thinking about this issue. It was specifically made for work that we did on income volatility, the fluctuations month to month that Americans are facing in their income and expenses. But it's kind of a useful way of thinking just generally about the universe of interventions that employers, financial service providers, or the government could take to help. So we identified three large categories, as you can see. Job quality is the foundational issue there on the left. We've talked a little bit about contingent work today, but even in the traditional workforce, there's a lot of precarity in work. I know it's come up in the Q&A, so I'm sure it's true here as well. And in the US especially, it's where, you have access to a retirement account, potentially health insurance, paid leave, a lot of benefits flow through that job. And so there's a number of potential interventions that you could take around just trying to increase the quality of jobs. The second is the safety net, which is basically the redistribution and social insurance functions that the government is playing in terms of creating programs, or in some cases tweaking existing programs to help consumers deal with their problems. One thing we found in the income volatility work is that these programs already exist in large part, right? Like unemployment insurance is a big program in the US that's supposed to help folks who have had rough luck in the labor market. Many American workers are not covered by UI, and benefits only flow to those who completely lose a job. So instead of, say, maybe losing hours at a job. So there's design features of these programs that are not particularly well adapted for the current types of challenges that we see in the workforce. The earned income tax credit is the big wage subsidy in the US, and it comes once a year as part of the tax refund in a huge lump sum payment. So it's actually a huge source of volatility for Americans, and it raises some of the questions that came up earlier about, do low income and middle income folks want a one-time payment like that, so that's kind of a forced savings mechanism, or would it be smarter to space that out over the year? There is evidence that, at least in terms of the EITC, a lot of workers are using that money to pay down debt that they took out earlier in the year. So in other words, they gave the US government an interest-free loan for 9 months and now are paying back their other debtors in much higher interest rates. So that doesn't seem like a particularly rational system, and there's ways that we can change the safety net to help people in the short-term challenges. And then finally, liquidity. Basically the insight here is that you've already, if there's a progression here in this framework, you've already gone to the labor market and earned what you're going to earn. You've received any benefits you're going to receive from the government in the safety net column. And now the liquidity challenge is just kind of moving money around from either the present to the future or the future to the present to meet obligations. So that could be savings, credit, or insurance. So we went on and identified 6 specific solutions, at least one in each category that we thought had particular promise. Those briefs are on our website. I'm not going to go through each one. In fact, I think I'll just skip ahead to the liquidity solutions that we identified just to start the conversation, because I think that those are probably the most relevant for the discussion today. So the first was shortfall savings, and again, this data is from the JP Morgan Chase Institute, basically showing that it's pretty significant sums that families need to even be able to, a financial buffer that they need to be able to deal with even a median amount of volatility that they're experiencing. And there's a lot of work that's going on that we've already heard a little bit about around trying to get people to save for the short term, whether through fintech apps or algorithms, banks rounding up purchases and trying to build savings that way. There are lots of challenges to uptake, and we've talked about a little bit of the distribution challenges, right? So there's a very crowded app space, and the folks who probably most need short-term savings tools are not in the iStore searching for budgeting apps, probably. They're busy, leading busy lives. And so there's challenges about getting employers and other kind of aggregators to take up these tools and expand access to them. And there's also an engagement challenge. So I think in the retirement sphere, we're happy with automatic enrollment, kind of set it and forget it. Sometimes the less somebody knows about the money that's building up, the better, so that they don't raid those accounts. But in an emergency savings account, you really want to make sure, of course, that the worker knows that the money is there and is using the money pretty regularly. That's the point. So that's one area where I think more work needs to be done on how you design those products. The second liquidity solution that we identified were payroll innovations. So as has been mentioned, that moment that you get your paycheck is a very momentous one, financially speaking. You're making decisions about where you're going to put that money and prioritizing. There's also lots of things that have happened before you got the money that were automatic withdrawals that you never saw, which is a very powerful tool for getting people to save or contribute to other benefit programs. And so we think there is a lot of opportunity here to improve that moment. So you could better align paydays with expenses, right? Most expenses come due at the beginning of the month. Why don't we have a payroll system that kind of inhabits that? You could also deduct additional expenses, like I said, for like emergency savings. There's proposals, and there's also employers and private firms that are experimenting with just more regular pay, giving folks access to their money quicker rather than waiting the 2 or 3 or 4 weeks after it's earned and before it's delivered to your account. Obviously it raises the same sort of scarcity questions of to what extent would that help with consumption smoothing, or to what extent do workers enjoy the kind of forced savings of that delayed. But there is, I think, a lot of work that can be done there. And then finally, we have hybrid products, and actually my former colleague Jeremy Smith was at this meeting last year and did an entire presentation on this, so I won't belabor the point, but the main insight here is that workers who need cash don't really care if it's coming from a savings account or an insurance product or a credit product. In fact, that's actually a very complicated decision to make, and we should try to build products that kind of do that work for you and potentially combine categories of products that have traditionally been siloed. The most excited, the one that we're most excited about is the sidecar account, which kind of bridges the short-term savings and the long-term savings. But there's lots of other potential ideas there. So why don't I stop there to leave about 20 minutes for Q&A. But thank you for your attention, and I appreciate the opportunity.